Welcome to the Value Vault, separating headlines from high-stakes opportunity may be knocking. All right, welcome. We've pulled together a fantastic stack of sources for this deep dive, really digging into the current financial landscape. We're looking at, everything from the big sweeping macro trends and major institutional moves, all the way down to the exciting, fast-moving world of digital economies, and even, well, the crucial element of individual mindset in navigating it all. Our mission is pretty straightforward. Take this pile of insights from market commentators, financial experts, technical analysts, extract the most important nuggets, and help you understand what's truly happening beneath those headlines.
That's exactly right. What's so compelling about this moment is how these kind of foundational elements of traditional finance, these burgeoning digital asset classes and massive global economic forces are all intersecting right now. It's not just academic. It's creating this really dynamic environment. It's filled with both significant challenges we need to be aware of and also remarkable opportunities for those who can see them clearly. Our goal here is really to cut through the noise, guide you through this intersection, help you pinpoint the core drivers and, well, understand where the leverage points really are in this rapidly changing world.
Okay, let's get right into it then. We're going to start by exploring perspectives on how let's say, the old financial world is beginning to seriously engage with the new digital one. And we'll layer in some insights on, economic reality and the individual psychology needed to navigate it all. We'll kick off with some analysis from, as he's often called, the internet's favorite Italian in fintech, Anthony Pompliano. He's been highlighting some truly significant shifts happening right at that intersection of traditional finance and the digital asset world.
Yeah, Pomp really zeroes in on a crucial macro setup right off the bat. He points directly to the U.S. national debt and highlights a specific figure, 8%. And he doesn't mince words, does he? He calls this the most important number in modern finance.
Wait, 8%. Why? Why 8%? What's the significance there?
Well, according to Anthony, in this current environment, which is really shaped by that debt when you're calculating the real return you're getting on your investment portfolio, you should basically take the nominal return, the percentage gain you see on paper, and subtract 8%.
Wait, subtract 8%? For my nominal return? That fundamentally changes the math for almost every traditional investment out there.
It absolutely does.
Right.
Just think about it. If your portfolio shows, say, a 10% nominal churn, which sounds pretty good on its own, Anthony's perspective is that your effective or real return, when you consider it against this macro backdrop, influenced by government borrowing costs and that debt burden, it's only around 2%.
Wow. Only 2%.
Yeah. The implication is profound. It means many perceived investment returns just aren't as impressive as they appear on paper. Once you factor in the context of that massive national debt and what that 8% represents, in terms of the government's cost of capital and its drag on the broader economy, it forces a total reconsideration of what a good return even means in this environment.
Right.
It's not just some random number. It's tied directly to the fiscal reality and, well, as long-term pressure on value.
That's a sobering reality check, definitely. But then Anthony pivots, doesn't he? He frames this challenging macro picture as a kind of crash course collision, a collision between the brand new world, which he identifies as Bitcoin and crypto, and the old world, the major established banks. And he argues that it's precisely at this intersection that the real opportunity lies.
Exactly.
It's not just about finding ways to make money, but maybe even more critically, about protecting the assets you already hold against those pressures created by the debt reality.
And this is where we're seeing a genuinely historic shift in behavior from those major financial institutions, the old world banks. Historically, their stance was clear and often pretty hostile.
Oh, yeah, very hostile. CEOs publicly dissing it.
Absolutely. Major bank CEOs were very public in their disdain for Bitcoin and crypto. There were even reports of employees being, discouraged or even penalized for getting involved. They certainly didn't offer crypto products to clients, didn't work with the early crypto ETFs, and maybe most tellingly, they wouldn't count any Bitcoin or crypto holdings their clients had as part of their net worth.
Right. So if you were applying for a loan or a mortgage.
Exactly. For loans, credit cards, mortgages, in the eyes of traditional banking balance sheets, these assets basically had zero value in that context.
A complete non-entity in the formal financial system. But that dismissal, that's really unraveling rapidly now, isn't it? Anthony highlighted the recent news about JP Morgan, one of the titans of the old world, beginning to offer client loans that are actually backed by Bitcoin and crypto ETFs. That's a huge shift.
It is, and it's a strategic one from their perspective. Pomp's take is that JP Morgan views these ETFs trading on a regulated market as being relatively low risk from an operational and regulatory standpoint. It's not fundamentally different from handling any other ETF, you see.
Okay, so the wrapper is familiar even if the underlying asset is new to them.
Precisely. While the asset might be volatile, the mechanism is familiar and regulated. It fits within their traditional risk management framework. But the implications go much further. JP Morgan and other major banks are now reportedly going even deeper. They're actively considering allowing clients to use their crypto holdings, whether that's in regulated ETFs or maybe even the actual coins held directly, when the bank is underwriting their net worth for things like personal loans, credit cards, or even assessing eligibility for a mortgage.
Wow. So if I have substantial crypto holdings, my bank might actually start seeing me as more creditworthy based on that. That was totally unthinkable just a few years ago.
Exactly. This is why it's being called a big deal, and really a concrete sign of mass adoption happening at the institutional level. The banks realize their clients, particularly younger or more forward-thinking wealthy individuals, hold these assets. And they need to figure out how to interact with them within the traditional financial system. They're figuring out how to onboard clients who have wealth denominated in these new forms.
Makes sense. They follow the money eventually.
They do. Anthony sees this intersection as incredibly fertile ground, both for innovation within finance and, of course, for generating investment returns. But he does add that crucial, historically grounded caution. Never, ever, ever bet against the American banks.
Right.
His point is, while they initially dismissed crypto, maybe even fought it, they are now finding ways to enter, adapt, and ultimately profit from it. They'll integrate it into their existing, very powerful structures.
That's a really powerful perspective on the institutional collision. Okay, so Anthony then took a fascinating turn, didn't he? Moving from this macro and institutional analysis to look at individual mentality. He featured that clip with Gary Vaynerchuk. This segment explores a different kind of intersection, the relationship between work, perceived opportunity, and what Gary V frames as, well, entitlement.
Yes, that clip is quite direct, isn't it? A stark contrast to the macro talk. It presents this specific scenario. An employee, Michelle, 7 years at her company, her office is closing, but in 3 years.
3 years notice, yeah.
Right. And employees who don't relocate are grandfathered into remote work. But here's the catch. They're told they're no longer eligible for promotions or lateral moves. So Michelle feels like leadership is ruining her job and asks, basically, should she stay without advancement or leave?
And Gary V's reaction was famously blunt and immediate. He called the employee obnoxious, seemed genuinely shocked at the complaint given the circumstances.
Absolutely. His core arguments were completely unapologetic. He focused first on the company's actions, pointing out they gave a 3-year notice, not 3 months, which he apparently assumed at first.
Yeah, he seemed surprised by the 3 years.
And that they weren't firing her. She could still work remotely. He characterized this as incredibly kind in today's competitive business environment. He stressed that running a company is inherently difficult, facing constant pressures like, the rise of AI that could fundamentally change the business. And he argued that companies can actually fail from coddling employees and not making tough decisions.
And he tied it directly back to the reality of advancement, didn't he? Particularly his view on the importance of physical presence.
That's absolutely central to his perspective, based on his own experience and, he says, conversations with other CEOs. Gary suggested that promotions and, top-tier compensation often go to those with face time with the executives or who are physically in the office with your team.
So basically, being there matters for getting ahead.
That's his view. He believes that while companies might publicly embrace remote or hybrid work, the practical reality for significant advancement is often different because of the human dynamics, trust, visibility, the impromptu collaboration that tends to happen more easily in person.
Which leads very strongly into his now famous stop complaining, start competing philosophy.
Right. His challenge to the employee, and really by extension anyone in a similar spot, was direct. If you truly believe you can run the business better, or if you're unhappy with the opportunities provided, go start a competitor.
Ouch.
Yeah. Otherwise, stop complaining because you're not willing to compete. He views perceived entitlement as a significant obstacle, both for individuals and for companies. His core belief, which he repeats often, is that hard work never, ever, ever goes out of style. And furthermore, doing that hard work in the office with your team is what, historically, he believes has been key to professional success and moving up. It's a tough take, for sure, but it's a perspective on the competitive nature of building value.
Okay, so how do we weave together these seemingly really distinct points? You've got massive national debt, banks suddenly embracing crypto, and this very direct take on workplace philosophy. What's the connection for the listener?
I think it's about understanding the multiple layers of change that are happening all at the same time and identifying where opportunity and leverage actually exist in this really dynamic environment. The macro pressure of that 8% debt figure and the subsequent institutional shift in how banks view and interact with digital assets like Bitcoin. That gives you a critical understanding of the broader economic backdrop your investments and your financial planning sit within.
Right, the context.
Exactly. It highlights the pressures on traditional stores of value and the emergence of new ones. Simultaneously, perspectives like Gary Vaynerchuk's, while they're focused on the individual workplace, they force us to consider our own agency, our adaptability, our expectations. In a world where career paths and work models are also being fundamentally reshaped by technology and economic forces.
Whether you agree with his bluntness or not.
Right, whether you agree or not, it challenges you to think about how you position yourself to capture opportunity and build value personally. Why does understanding bank capitulation matter? Because it validates a new asset class as having enduring value within the existing powerful financial system. It opens new doors. Why does a perspective on entitlement versus competition matter for your own financial and career journey? Because it challenges you to assess whether your expectations align with the realities of building value in a competitive economy, whether that's starting a business, advancing in a company, or allocating your capital. It's all interconnected in terms of adapting to a world that is rapidly, really rapidly becoming something new.
That makes a lot of sense. Drop a like and share if you find this valuable. Okay, building on that idea of navigating a changing landscape and the emergence of new economic structures, let's transition from the macro and institutional shifts we just discussed with Anthony Pompliano's insights to look at the actual building blocks of a potential new digital economy. This is explored in another set of sources from Raoul Pal's Real Vision, and specifically the Journeyman series.
Yeah, this section takes us into a really deep dive with Manny Stoltz, who is the president of the TON Foundation. Manny brings a really unique perspective because his background is deeply rooted in emerging and frontier markets. He worked with Kingsway Capital.
Right, EM Frontier, different world.
Totally. And the Journeyman series on Real Vision, its whole mission is finding that nexus of understanding between macro, crypto, and the exponential age.
Yeah.
Manny's experience applying emerging market principles to the digital asset world fits perfectly into that mission. It's a fascinating lens.
And TON, the project Manny's leading, has a particularly interesting, maybe even challenging starting point because it's built on the Telegram messaging platform, which already has, what, a billion users?
A billion users,
Right.
yeah. That's fundamentally different from almost every other blockchain project out there. Most start with a technology or a product and then desperately try to build a user base from scratch.
Right, build it and hope they come.
Exactly. Yeah. TO's primary problem isn't finding users. It's getting the existing massive user base of Telegram to actually adopt, understand, and use the TON token and its ecosystem for, real economic activity.
That's a huge hurdle in itself, just getting people to change behavior.
It is, and this is precisely where Manny connects his extensive experience in emerging markets to the core mission of TON. He speaks really passionately about the 3 billion unbanked or underbanked people globally. He highlights that a huge portion of these individuals live in countries plagued by hyperinflating or, profoundly unstable fiat currencies.
Like the examples he gave.
Yeah, he recounts personal experiences with this, talking about the volatile Zimbabwean dollar, the significant devaluation of the Nigerian naira recently. Manny sees this lack of access to stable money or reliable financial services not just as an economic problem, but fundamentally as a human rights problem.
Wow. Human rights problem. That's a strong statement.
It is. And he argues that for the first time in history, the widespread adoption of smartphones offers a potential way out of this. It provides a pathway for the poorest people in the world to access and choose the same stores of value in cyberspace. Whether that's stablecoins pegged to strong currencies, Bitcoin, or even native network tokens like TON, the same assets that were previously only accessible to the wealthy.
Democratization through tech.
Exactly. His belief is that this capability, facilitated by mobile technology and digital assets, has the potential to make a massive dent into poverty reduction, financial inclusion, and economic empowerment on a truly global scale.
That's an incredibly powerful framing, seeing digital assets and these network economies as a tool for addressing a global human rights issue. And he draws a very direct analogy, doesn't he, between the characteristics of the crypto world and those emerging frontier markets he knows so well.
He absolutely does. Manny views the crypto world as mirroring EM frontier markets in numerous significant ways.
Hmm.
He talks about the difficult market access, the often complicated or opaque governance structures.
Yeah, the Wild West feel sometimes.
Right. The inherent volatility of these nascent economies and the constant risk of things that can rug pull you all the time, which is unfortunately common in less mature financial environments. He frames the work happening in crypto as basically like building small businesses and entire economies in these highly volatile digital environments. He even reflects that given his background navigating the complexities and instability of real-world frontier markets, in hindsight it was inevitable, he would end up deeply involved in this digital frontier.
Which kind of crystallizes into this fascinating concept he calls the network continent. Can you elaborate on that?
Yeah, the network continent. He envisions Cryptoland, this collective digital asset space, as a new promised world, essentially a digital continent where people can migrate to seek better economic opportunity and freedom. He draws this really evocative analogy to the Mayflower voyage.
Wow.
And within this continent, which he calls the fastest growing economy the world has ever seen, he sees developments like the new Bitcoin ETFs, not just as financial products, but as a form of foreign direct investment, FDI, flowing from the traditional fiat world into this new digital landmass.
So capital migration.
Exactly.
Yeah.
And within this continent, he sees major established protocols like Bitcoin and Ethereum acting almost like sub-nation states, foundational economic entities within the larger digital geography.
It's interesting to hear about his personal journey into this space, too, starting from a traditional finance background and having some initial skepticism.
He's very open about it. He admits that initially when he first encountered Bitcoin from his traditional finance perspective, he thought of it pretty derisively, called it magic beans or magic internet money. Didn't take it seriously at all.
A common reaction back then.
Very common. He says that changing his view required a significant degree of humility, especially after experiencing the tangible impact of currency instability firsthand in emerging markets, and then doing the deep research into Bitcoin and decentralized systems. The fact that his firm, Kingsway Capital, which specializes in frontier markets, now makes institutional crypto investments, well, that speaks volumes about how compelling the thesis became, even for those rooted in traditional finance.
Definitely adds weight. So bringing it back to TON specifically, what is its core unique advantage and its grand vision within this whole network continent framework?
TON's absolutely almost unfair competitive advantage is its integration with Telegram's massive existing distribution network, that billion users. Manny uses a great analogy. He quotes Bill Gates saying content is king, but Manny adds distribution is the queen, and critically, she's wearing the pants.
Yeah. Okay. Distribution rules.
Distribution rules. He compares the potential of TON on Telegram to the super app models prevalent in the East, like Tencent WeChat, where a single platform becomes the hub for communication, social interaction, and increasingly all sorts of economic activity.
Right. Everything in one place.
The vision is that Telegram provides the fundamental freedom of speech layer, a secure, censorship-resistant communication network. On top of that, TON provides the essential property rights layer and the economic layer. This combination, in their view, has the potential for putting freedom into orbit, creating a complete digital ecosystem that explicitly stands in contrast to, well, the potential digital dystopia represented by centrally controlled central bank digital currencies, or CBDCs.
And they're not just building abstract layers, right? They're implementing concrete, practical use cases for Toncoin and the TON ecosystem.
That's the critical next step, making it tangible and useful for users. Manny listed several examples of how Toncoin and TON's capabilities are being used or are planned. A major one is Venmo-like peer-to-peer payments directly through your Telegram contacts.
That's huge for remittances.
Massive potential for facilitating remittances globally, especially in those emerging markets where sending money is often slow, expensive, and cumbersome. They are also integrating platform monetization, like Telegram Stars, where users can buy digital goods, gifts, or interact with AI chatbots using Toncoin. This allows influencers and creators to potentially avoid traditional, often high, platform fees.
Cutting out the middleman.
Exactly. There's also the potential to put real-world assets, RWAs, on-chain. He mentioned possibly even putting Telegram's own convertible bonds on-chain in the future. And a very recent concrete example is the launch of Tether Gold on TON.
Tether Gold, so fractional gold ownership.
Exactly. making fractional ownership of physical gold accessible even to poorer individuals in emerging markets via their phones, bypassing the high cost of physical jewelry or the high barrier to entry for traditional gold investment markets. Manny emphasizes that the design space for TON is really focused on achieving push-button ease, like using the internet or a simple messaging app, not the complex user experience often associated with traditional crypto wallets, gas fees, seed phrases.
Yeah, the friction is still a big barrier for mass adoption.
It is. So this user experience focus is absolutely key for unlocking that billion user potential.
Okay, despite this really ambitious vision and the existing user base, Manny is very clear that there are significant challenges to overcome. Raul Powell in the conversation pointed out the current user experience issues quite directly, didn't he? Saying something like, "Where are the apps? It's so not obvious how to use this ecosystem right now."
And Manny agreed, yeah. He acknowledged that the UX UI is definitely a work in progress. It has to be. A massive challenge is building for that truly global audience where, remember, 80% of Telegram's users are in emerging
Right.
markets.
Diverse needs, diverse tech access.
Exactly. This means considering low bandwidth environments, lower-end devices, diverse languages, varying levels of digital literacy. It's a huge undertaking. Their strategic focus areas are designed to tackle these challenges and unlock the network effect. Priority number one, he said, is a decisive U.S. market entry. They're targeting around July 4th.
Ambitious timeline.
Very. It involves unblocking the TON wallet for U.S. users and securing listings on major U.S. exchanges. That's crucial for global credibility and liquidity. They're also doubling down on key growth areas like stablecoins, gaming, and that platform monetization piece, and strategically entering new geographic markets like Korea was mentioned. Mandy stressed that with such a large existing base, there's a real risk of complacency. They need to maintain relative speed compared to other competing blockchain ecosystems. And then there's the elephant in the room, the perceived geopolitical risk associated with Telegram itself. Given its historical connections, founder Pavlo Durov's very public, strong stance against government pressure and surveillance globally, that must cast a shadow.
That is absolutely a valid and significant concern, no doubt about it. Telegram's founding principle, providing a secure, freedom of speech-focused communication platform, inherently puts it in conflict with governments that seek control and surveillance over digital communications and economic activity.
Yeah, they don't like things they can't control.
Pretty much. Many mention instances where Pavel has gone public about being approached by intelligence agencies wanting backdoors or data. The concern is how powerful regulatory bodies, particularly in places like Europe, might react to a massive, economically enabled, decentralized network that is explicitly designed to operate outside traditional state control. They could potentially view it as a threat or seek to impose significant restrictions or regulations. It raises fundamental questions, doesn't it, about the future of such a project operating globally while trying to maintain those freedom-centric principles.
It really does. Yet, Manny frames this very risk as also being part of the massive potential. He sees TON as a potentially trillion-dollar outcome that could emerge outside the direct control or influence of the US and China. He contrasted specifically with Europe's current perceived lag in the global tech race.
So positioning it as a sort of independent, free world tech alternative.
Precisely. He sees it as potentially one of the most significant experiments in building a large-scale digital economy from the free world, distinct from the tech ecosystems dominated by the US and China. If TON can successfully navigate these challenges, leverage Telegram's incredible network, and execute on its vision of putting economic freedom into orbit, he believes it could indeed become a trillion-dollar idea with profound implications for global financial inclusion and individual digital sovereignty. He's realistic, though. The journey won't be a straight line. It will be complex, full of obstacles. But the potential reward for global empowerment is immense.
So wrapping this section up, why does understanding TON and this whole network continent concept matter to you, the listener?
Because understanding TON is understanding one of the most significant real-time experiments in building a truly decentralized digital economy on top of a massive established user base. It's not just theory, it's leveraging 1 billion people. It's a concrete case study in the network state concept being done right now as we speak.
The real-world implications are huge.
They are. The implications it has for global financial inclusion, particularly for the unbanked and those dealing with unstable currencies, are enormous. And its mission to provide an economic layer alongside Telegram's freedom of speech layer raises crucial questions about digital freedom and sovereignty in an age of increasing central control. Watching how TON navigates the challenges, user adoption, infrastructure build-out, geopolitical pressure, provides invaluable insights into the future trajectory of decentralized networks and digital economies on a global scale. It's really a vivid example of the digital frontier expanding and attempting to onboard a significant portion of the planet.
Okay, fascinating stuff. Let's pivot slightly now, moving from the emergence of these new digital economies to broader macro forces and how they inform market structure and portfolio strategy. We'll draw insights here from Darius Dale at 42 Macro. He provides a perspective grounded in the U.S. fiscal situation and offers a framework for navigating it.
Yeah, Darius dove into the ongoing political sparring in the U.S., specifically around President Trump's proposed tax and spending bill. He pointed to the intense debate and criticism it's received, notably calling out Elon Musk's incredibly strong reaction, labeling it a disgusting abomination.
Strong words.
Very. A sentiment echoed by many fiscal hawks within the Republican Party. But then on the flip side, you have figures like House Speaker Johnson defending aspects of it and the White House pushing back, calling it, quote, one big, beautiful bill.
Sounds like pretty standard dramatic Washington politics. Kind of noisy.
It is, and Darius frames it precisely that way.
Mm-hmm.
Performative congressional brinksmanship. He highlights that much of the public back and forth centers on these contentious issues. The SALT cap, which hits taxpayers in high-tax states.
Right. Always a flashpoint.
Discussions around raising the debt limit, potential changes to Medicaid work requirements, and those clean energy tax credits. The very credits Elon Musk was vocal about Tesla Energy benefiting from, remember.
Mm-hmm.
Darius's advice to investors watching this drama unfold is basically to fade it.
Fade it, meaning ignore it.
Essentially, yeah. Don't get overly distracted or emotionally invested in the public spectacle because, in his view, the underlying trajectory of fiscal policy is actually more predictable than the headlines suggest.
Okay. And based on his analysis, what are Darius's probabilities for this bill actually passing and, maybe more importantly, its potential impact?
He assigns a pretty high probability, 75% or greater, that the bill, or something substantially similar, survives the reconciliation process and becomes law. Furthermore, he gives a reasonable probability, somewhere between 50% and 75%, that the final bill actually ends up being bigger in terms of its overall fiscal impact.
Bigger, meaning more spending, more debt.
Exactly, meaning it will contribute even more to increasing the national debt than currently projected. So, despite all the loud criticism from fiscal hawks, the expectation from his perspective is for continued and potentially even accelerating fiscal expansion.
Which ties directly back to points we've heard elsewhere about ongoing fiscal largesse or government spending in the U.S. economy.
Exactly right. Darius uses that public warning from Tesla Energy about potential cuts to clean energy tax credits. The warning Musk himself amplified as a prime example. He connects this back to his consistent argument that this kind of ongoing fiscal largesse is a significant factor driving the K-shaped nature of the U.S. economy.
The K-shaped recovery where different segments perform very differently.
Precisely. He argues that rich people and the companies they own or run, like Tesla or SpaceX, benefit disproportionately more each year from federal government outlays, subsidies, and tax breaks compared to lower-income individuals.
So his view is essentially that the system is fundamentally rigged.
He states clearly that, yes, the system is rigged in this manner, but he adds a crucial, almost counterintuitive nuance. Precisely because the system is structured this way, and the rich benefit so significantly from the fiscal spigot, as he calls it. The U.S. economy is likely to remain remarkably resilient until that spigot is either dramatically tightened or turned off.
Okay, so the structure benefits the wealthy, which in turn keeps the economy afloat in a way.
That's his argument. And he notes that his own research, which is represented by his bullish paradigm C framework, actually anticipates this spigot being turned up, not off.
Turned up, so even more stimulus.
Suggesting continued tailwinds for assets favored by those who benefit most from fiscal stimulus.
Okay, given this macro backdrop, rising debt, likely continued fiscal expansion, a K-shaped economy, what's Darius's recommended portfolio strategy for navigating this?
He advocates for a portfolio structure he calls KISS, simple acronym. Stocks, gold, Bitcoin, and explicitly no bonds.
No bonds at all. Wow, that's a significant departure from classic portfolio construction, like the standard 60-40 split everyone talks about.
It is a major shift.
Yeah.
His rationale for excluding bonds is pretty straightforward. He argues that in the current and expected environment, traditional bonds are just an unattractive asset class because, after you account for inflation and yield relative to debt costs, you're effectively losing money on the actual principal in real terms over time.
Losing real value. Ouch. much.
Yeah. He even makes the provocative statement that Bitcoin, in this new macro context, is effectively the new bond.
Interesting take. How does he measure the performance of this KISS strategy?
He benchmarks it rigorously, not only against the traditional 60-40 portfolio, which he says it demonstrably trounces, but also against a simple naked long portfolio. That naked long portfolio is composed of 60% stocks, 30% gold, and 10% Bitcoin. Basically what the KISS portfolio looks like when it's fully invested in risk-on assets.
Okay, so comparing his active strategy to just holding those assets passively, what do the metrics show?
The key metrics he cites are pretty impressive, especially for risk management. Compared to being passively invested 60-30-10 at all times, the KISS strategy, through its active management signals, has an upside capture ratio of about 90%, so it captures roughly 90% of the gains during upswings.
Pretty good upside capture. What about the downside?
That's the crucial part. It has a downside capture ratio of less than 50%, often closer to 40%.
Less than half the downside.
Exactly. During drawdowns, the portfolio experiences less than half the losses of that passive 60-30-10 mix. Darius frames this benefit as chopping off the left tail of the potential return distribution.
Reducing the worst-case scenarios.
Precisely. It significantly reduces the probability and severity of extreme negative outcomes, which, as he puts it, helps investors sleep well at night. It's about trying to achieve asymmetric returns, getting most of the upside with significantly less than half the downside.
Now, one potential misconception about a strategy that involves allocation shifts, even if infrequent, is that it requires constant high-frequency trading. Is that the case here?
Darius directly addresses this. He calls that idea a flat-out misnomer for his strategy. He emphasizes that KISS is not about constant buying and selling or trying to time the market precisely day to day.
Okay, so what is it then?
He states it's designed to be a low volatility, low turnover strategy. On average, it generates only about 2 trades per month.
2 trades a month. That's really not much at all.
It's significantly less frequent than the trading activity of the average retail investor, who might make multiple trades daily or weekly sometimes. He positions it as a macro-driven asset allocation strategy designed to help long-term investors, including retail, retire comfortably by managing risk effectively, not as a high-frequency trading system.
Got it. Another common and really important question, particularly when discussing strategies that involve active adjustments, is taxes. How do taxes impact the performance, especially when you compare it to a simple long-term buy and hold approach where taxes are deferred until you sell way down the line?
Yeah, this is indeed a complex point, and Darius is pretty pragmatic about it. He highlights that tax situations are incredibly varied. 42 Macro has clients in over 80 countries, each with different tax laws. Plus, individuals have different account types, taxable versus tax-advantaged retirement accounts.
Impossible to optimize for everyone.
Right. They simply cannot build a single strategy that optimizes for every possible tax permutation globally. The strategy itself provides the risk management framework and the potential performance enhancement. But the specific tax implementation is ultimately up to the individual investor based on their circumstances and location. He does offer a provocative perspective on this, though.
Oh.
He suggests that taxes become somewhat less relevant when assets appreciate significantly and you reach a high watermark. His point, delivered with characteristic Darius bluntness, is that the potential long-term wealth creation and risk management benefit of the strategy, if successful, could potentially dwarf the tax considerations over time, suggesting that what he views as silly questions about taxes tend to disappear for investors who achieve significant performance.
Interesting perspective. Prioritize strategy and performance first.
That seems to be his core message on that point. Focus on managing risk and capturing asymmetry, and the tax part becomes a secondary optimization problem later, potentially a much smaller problem if the strategy works well.
Okay, so what are the key takeaways for our listener from this deep dive into Darius Dale's perspective? How does it help them?
Well, first, it provides essential context for the macro environment in which all your investments operate. Understanding the political dynamics around fiscal bills, the high likelihood of continued debt expansion, and that concept of a K-shaped economy. That gives you a framework for understanding the tailwinds and headwinds in the market right now.
Sets the stage.
Exactly. Second, the KISS strategy offers a specific, data-driven potential alternative portfolio structure. It challenges conventional wisdom by excluding bonds and explicitly including Bitcoin alongside stocks and gold. It's based on a risk management framework designed to capture significant upside while limiting downside that chopping off the left tail is a really powerful idea for long-term compounding.
And it's not about frantic trading.
All right. Third, it clarifies that sophisticated strategies aren't necessarily about high-frequency trading. And finally, it forces you to think critically about how taxes fit into your personal investment plan after the strategic allocation decisions are made, rather than letting tax be the primary driver of those decisions. It's really about seeing the major forces shaping the market and having a potential framework for navigating them with risk management as a top priority.
All right, excellent. Let's shift gears one more time now. We'll move from these broad macro and strategic perspectives to focusing on these specific market signals and price action, drawing from the analysis presented in Real Vision's Trading the Markets.
Okay, this section is all about reading the charts and understanding what the current price movements might be telling us about the state of the market, particularly for crypto assets. The analysis specifically looked at Bitcoin's recent correction, which was roughly 8.5% at the time of recording. The key question, of course, is the one everyone's asking. Is the bottom in for this pullback?
The $1,000,000 question,
Uh-huh.
or maybe the $100,000 question for Bitcoin.
Right. They discussed whether the size of this correction is typical or sufficient compared to pullbacks in previous bull market cycles. Seems generally in line. They also examined market sentiment, noting it's still hovering around the 60s on certain indicators, which usually registers as greed.
Still greedy, not fearful yet.
Not deeply fearful, no. Ideally, for a truly healthy and decisive sentiment reset, you'd want to see sentiment wash out further, perhaps dropping into the 50s or even the 40s on those greed fear indexes.
Okay, so sentiment isn't indicating full capitulation yet, but the correction size itself isn't necessarily unusual in this cycle. What are the actual technical indicators on the charts showing?
They looked at several. One was the trading alpha indicator, which apparently suggests Bitcoin has held a crucial support level despite the selling pressure during this correction. Importantly, the charts are also showing a volatility squeeze. You see the classic Bollinger Bands tightening significantly.
Bollinger Bands tightening, meaning a big move is likely coming.
Exactly. When these bands narrow like this, it's a signal that a significant price move is likely brewing, though the direction isn't guaranteed immediately. Could break up or down. However, the fact that price has been consolidating sideways on that support level increases the statistical odds, in their view, of that impending breakout being to the upside. Consolidation on support is generally bullish.
Okay. And what about traditional moving averages, which many traders use to identify the short-term trend?
Looking at standard moving averages, Bitcoin is currently described as being in no man's land,
No man's land.
meaning it's trading below the short-term 10 and 20-day moving averages, but still above deeper, longer-term support levels.
Oh.
A crucial signal that a potential bottom is definitively in or would be seeing Bitcoin close decisively above those 10 and 20-day moving averages, particularly on a weekly chart for confirmation.
So reclaiming those short-term trend lines, what if it doesn't? What are the key downside support levels to watch?
They detailed potential downside support levels if the current price structure were to break. The psychological level of $100,000 is one natural point of interest, obviously, but a stronger structural support area exists in the mid-90s, specifically around $96,000 down to maybe $93,500.
Okay, mid-90s. Would a drop there break the bull market?
Not necessarily. They emphasize that even a move down to this mid-90s range wouldn't necessarily break the longer-term uptrend line or the critical 20-week bull market support band. In fact, hitting those levels could potentially serve as that healthy sentiment reset they mentioned earlier, washing out the weak hands and providing a stronger springboard for the next move up.
So summarizing the Bitcoin outlook based on this technical view, what's the bottom line?
The outlook is one of cautious optimism, really. They see perhaps a 50-50 chance, maybe slightly better, that the bottom for this specific correction is already in at current price levels. However, they are advocating patience, waiting for the market to provide a clearer signal.
Don't jump the gun.
Exactly. That key signal would be a sustained move, particularly a weekly close, back above the 10 and 20-day moving averages. Until then, it's a waiting game near support, keeping a close eye on that volatility squeeze.
Okay, makes sense. Moving beyond Bitcoin now, how are altcoins performing relative to BTC right now? Is it altcoin season yet?
They looked at a broad altcoin index, which tracks 90-day outperformance relative to Bitcoin. But the crucial detail was drilling down. How many individual altcoins are actually outpacing Bitcoin consistently?
The devil's in the details.
Always. Out of the top 100 altcoins by market cap, only a small fraction, just 22, were currently showing sustained outperformance against BTC at the time. That statistic really highlights Bitcoin's continued dominance in the market structure right now. It's the king. And they added a really important nuance here. You must check the individual charts for specific altcoins. Don't rely just on an index.
Why is that?
Because an altcoin might look like it's outperforming on a 90-day index simply because of one recent sharp spike. But its chart against Bitcoin, the alt-BTC pair, might still be stuck in a long-term downtrend.
Ah, okay, like a dead cat bounce against BTC.
Exactly. They use Ethereum as an example. While ETH might show 90-day outperformance in the index after its recent bounce, its crucial ETH BTC chart still needs to make higher highs and higher lows to confirm sustained strength relative to Bitcoin.
So the conclusion is that Bitcoin remains a very strong default holding, and consistently outperforming it with altcoins is actually quite difficult for the vast majority.
That's absolutely the takeaway from their analysis right now. Outperforming Bitcoin significantly, especially over longer time frames, is an incredibly challenging feat for most altcoins. They caution that chasing marginal outperformance with altcoins might not be worth the increased risk and complexity compared to simply holding Bitcoin, which is currently showing fundamental dominance in the market structure.
Okay, this brings us directly to listener questions about specific altcoins and potential allocation swaps. The first question was about swapping XRP or TAO for ETH. What did the chart suggest?
Right, looking at the charts they analyzed for these three. Ethereum, ETHist, had that notable bounce following its Dinkin upgrade, and has generally been holding on to those gains relatively well compared to some other large-cap alts like Solana or SUI recently. On the daily chart against the dollar, ETH looked relatively strong compared to some peers, holding above its moving averages better.
Okay, but what about against Bitcoin?
That's the key. The crucial ETH BTC chart, which measures its performance against Bitcoin, still needs to show clearer signs of setting higher highs to confirm sustained long-term strength relative to BTC. It's trying, but not definitive yet.
And XRP, how did that look?
XRP's chart, by contrast, appeared weaker right now. It looked like it was rolling over, and structurally it was showing patterns more similar to SOL or SUI than to ETH at that moment.
Okay, and TAO, that's Bit and Soar, right? Different beast.
Totally different beast, primarily because KO has a significantly smaller market cap compared to both ETH and XRP.
Which implies different risk and potential reward profiles, I assume.
Precisely. Because of its smaller market cap, TAO mathematically has potentially higher percentage upside potential if it gains significant traction and narrative momentum. However, it sits much further out on the risk curve. It is highly volatile and requires much more constant monitoring and active management compared to larger caps like ETH.
So the decision really depends on the individual's risk appetite.
Heavily. The decision between swapping into ETH versus staying in XRP or TAO depends heavily on your individual risk tolerance and your willingness and ability to actively monitor highly volatile assets. Based purely on the current chart structures presented in the analysis, ETH appeared to be a lower risk option than XRP and significantly lower risk than the much more volatile TAO.
Makes sense. Another question asked about swapping SOL for SUI. Both have had strong runs at times. What was the advice there?
They highlighted the inherent risk in doing these direct swaps between similar altcoins. The common pitfall is selling the asset you hold, only for that one to then go on a significant price run right after you sell it. It's incredibly frustrating.
Been there, done that.
Haven't we all? They explain that assets like SOL and SUI, while sometimes moving together directionally, also have their own individual cycles. These cycles are driven by specific narratives, development milestones, ecosystem growth, or just market dynamics. It's incredibly difficult, if not impossible, to predict which one will outperform the other in the short to medium term.
So flipping a coin might be just as good.
Almost. Their recommendation, if you're uncertain or hesitant about making a direct swap, is actually to consider holding both SOL and SUI as a strategy. Split the allocation. Both have potential narratives and ecosystems. Trying to time a swap perfectly between them often results in what traders call getting chopped up, buying high, selling low, and potentially ending up with less value than if you just held onto your original position or split your allocation.
Hold both if you like both, basically.
That seemed to be the advice.
Yeah.
SUI does have a lower market cap than SOL, offering potentially higher percentage gains, but likely also higher volatility and risk. Holding both diversifies that specific bet.
Okay, let's finish this section by spotlighting SPX. That's a meme coin that's been performing incredibly strongly recently, right?
Yes, SPX.
Yeah.
It has been on an absolute tear, according to the analysis. Its performance has been outstanding, significantly outpacing everything else discussed, including outperforming Bitcoin by more than 3x from its recent lows. It was nearing its all-time high when they looked at it.
Wow, 3x versus BTC from the lows. What's the chart look like?
The chart strength was described as undeniable. It showed strongly upward trending moving averages, expanding volatility bands confirming the upward momentum, and a classic technical breakout pattern that validated a strong uptrend. Textbook stuff, apparently.
What's driving this performance, according to the analysis? And what's the technical view on potential entry timing, given it's run so hard already?
They framed meme coins, particularly those with really strong dedicated communities, as having become a kind of legit sector in crypto now, whether you like it or not.
Driven by narrative and community.
Primarily driven by attention and the power of their rabid communities. The SPX community was described vividly cult mode, almost like a new religion for its followers. That fuels intense loyalty and buying pressure. Out of the meme charts they reviewed, SPX was deemed to look the best technically by far.
Okay, so technically strong, but entry timing, it's near all-time highs. Risky.
Always risky buying something that's run hard. Regarding potential entry timing after its significant run-up, it did experience a roughly 30% correction just before this latest leg up, and it's now showing that strong breakout confirmation. The suggested technical approach for a potential entry, if someone was inclined, would be to wait for a retest or touch of the 10-day or 20-day moving average.
Wait for a pullback to support.
Exactly. And how price reacts at those levels is key. If it touches the moving average and then consolidates sideways or quickly bounces off it, that increases the odds of it being a good entry point for the next leg. If, however, it slices straight through those moving averages quickly on high volume, it might signal further downside is coming and suggest waiting longer or avoiding it.
But there's a risk it doesn't pull back, right?
Absolutely. They acknowledge the inherent risk of waiting. The fear of missing out is real. It could just continue running higher without offering that clean pullback to the moving averages. High momentum assets can do that.
Got it. And finally, a quick question about Toshi, which is a meme coin on the base chain. Any thoughts there?
Their brief analysis compared Toshi directly to SPX. The suggestion was that if you're considering putting money into a meme right now, based purely on the charts reviewed, you might be better off waiting for a potential entry point on SPX instead of chasing Toshi.
Why is that?
They expressed some doubt about whether base chain memes like Toshi currently have the same kind of enduring stickiness or the proven community strength as some of the more established, culturally resonant memes like SPX seems to have developed. Looking briefly at the Toshi chart, it appeared choppy, with average performance recently, and notably declining volume after its initial spike. It just wasn't showing the same clear technical strength or momentum as SPX.
Okay, so SPX looked stronger technically and maybe narratively. Understood. This technical analysis section provides specific levels and indicators that our listener can actually watch on their own charts, which is really helpful.
It does. Understanding these charts provides tangible tools. It helps you make more informed decisions in real time about potential entry and exit points, and crucially, about managing risk across different asset classes, whether it's monitoring Bitcoin's key moving averages and support zones, evaluating altcoin performance relative to BTC using the actual pair charts, or looking for technical signals to potentially time an entry into something as volatile as a meme coin like SPX. This type of analysis is crucial for navigating the current market chop and positioning yourself for potential opportunities by understanding the underlying price action and technical structure.
So we've definitely covered a lot of ground today. We went from the macro pressures of national debt and the institutional embrace of digital assets to a really provocative perspective on work culture, the ambitious vision of building digital nations on messenger apps. And finally, peering right into the charts to find market signals in real time. It's incredibly clear that the landscape across finance, technology, and even individual opportunity is complex and constantly, rapidly evolving.
Absolutely. Whether you're analyzing the fundamental pressures on traditional financial systems, like that U.S. fiscal situation Darius Dale highlighted, or considering the massive potential user base and societal impact of a digital economy being built on a messenger app like Telegram with TON, or even looking at the specific technical strength of an individual, maybe speculative, asset like SPX, it's all about identifying where value is truly being created, transferred, and stored in this rapidly changing world. It requires looking at these different layers, the macro, the institutional, the technological, the individual asset level, and understanding how they intersect and influence each other. Navigating this requires adaptability and, frankly, a willingness to look beyond just the surface-level headlines.
This raises a really important question, I think, for you, the listener, to ponder as we wrap up today's deep dive. In a world where traditional power structures and financial systems are intersecting, maybe even colliding, with increasingly powerful and decentralized digital networks, how will this collision ultimately reshape not just finance and wealth, but global society and the very nature of individual opportunity? And perhaps more personally, in a world defined by increasing fiscal uncertainty and accelerating technological change, where do you choose to build and secure your financial future?
A lot to think about there. Where do you place your bets, your time, your capital in this shifting landscape? It's the critical question.
Markets move fast. Pinpoint your next profit window and seize the moment.